cover chapter 4 today. A lot of this portion right here is going to be, could be repetitive, could be new information for you. But Jarrell, Samantha, Jade, Sebastian, good to see you all, everyone, today. We are going to cover a couple things on getting good at third-party policies, life settlement options, group insurance, retirement accounts. Boom, boom, boom. Let's go through here. Let's see. If you have not already printed out your chapter recap, I would again encourage you to go back and do that. This will give you all the information here. It's going to give us a lot of the same information today, but we're going to make sure that we go through most of this stuff today to give you guys a good standpoint for where we're at. Okay, let's talk about third-party ownership, Jarrell. Third-party ownership is when a third-party company or party owns your policy. A third-party owner could be a business partner, a parent, a grandparent, a spouse owning your policy. That would be a third-party ownership. Life settlements. Let's kind of scan through this right quick so we know what this is. Okay. Okay, the term life settlement is refers to any financial transaction which the owner of a life insurance policy sells the policy to a third party for some form of compensation, usually cash. So I said this a couple chapters ago where there are companies that will buy your policy, Sebastian, based off of whatever your example is, okay? So in order to define how that works, let's go through the example. A person age 70 owns $1 million life insurance policy. He recently sold his business for 5 million and he decided that he no longer needs life insurance coverage. The cash value of the policy is $390, $390,000, which the insurance company policy owner, if he cashed it out, he would get that amount of money. A life settlement provider may come in and offer, after reviewing medical records, might offer him for $575,000. Once the ownership is transferred and the policy has received its funds, the life settlement party assumes the new premium until the insured dies, in which they would receive the $1 million death benefit. Crazy business, right, Sebastian? You're 70 years old, they're reviewing your medical records. You don't need life insurance anymore. They said, hey, we're going to give you a little bit over half your policy value. And when you pass away, if you pass, I'm sorry, when you pass away, we're going to cash out on the extra money. Sounds like a pretty crazy investment. Let's go through the definitions of this. The term business of life settlement refers to any activity relating to solicitation or sale of the life insurance contract when they have no insurability. So, Samantha, remember, insurable interest is when, in order to have that, there has to be in the event of a loss, when you're writing the application, that is defines insurable interest. When you sell your policy, well, doesn't have to be any insurable interest. You can just sell your policy just to sell it. And pretty crazy story when you can do that. Do I need to go? Okay. Um, let's go through the next one. Insured. Obviously, that's the person covered under the policy. Life expectancy. That just refers to, hey, based off the average age of a person living due to mortality risk and medical history, when are they due to die? What's the definition of a life settlement contract, Jarrell? It establishes in terms which a life settlement provider will pay compensation to the policy owner. In return for assignment, if you remember the word assignment, it means transfer of ownership. In this situation, this would be an absolute assignment, meaning they are giving a permanent transfer of ownership to this third party. Life settlement broker. So this is a person's job. This person for compensation solicits, negotiates, and offer negotiation for life settlement contracts. That's pretty crazy. And you have a job that you go out there and you start looking for people who got some money and maybe might want to sell their policies. Life settlement provider is a person other than the owner who enters the life settlement contract as the new owner. Pretty straightforward with that. Any questions? No? Okay, good. All right, let's go on to the next thing. Okay, start a whole new page for group insurance. I'm going to summarize this, okay? All right, so group life insurance. I want you to write the employee receives a certificate of insurance. The employee receives a certificate of insurance. The employer receives the master contract. So if anyone ever says they have life insurance through their job, understand the employee does not control anything about that life insurance policy. Um, so the employee receives a certificate of insurance. The employer controls the master copy. And Jarrell, the type of coverage that is provided is called annually renewable term. So you're going to write the coverage provided is called annually renewable term. And if you remember what annually renewable term means, it means that the coverage will go up every year, Jade. Alvaro, the coverage will go up every year. Good to see him in the background. Um, the coverage goes up every year. The premium goes up every year. Forgive me, guys. I was totally distracted. The coverage does not go up every year. Annually renewable term, the premium goes up every year. It renews the coverage, Jarrell, with no medical questions. And the reason the premium goes up every year, Samantha, is because it's annually renewable. It renews every year. Um, I don't know. Jarrell, you got me yawning, bro. Come on. All right. So when you have a group policy, you can do up to 50, that's going to come later in the contract, later in the chapter. You have what is called a conversion privilege. So write this under group insurance. Conversion privilege. This allows you, Samantha, that if you leave the job, you can convert the policy to a whole life policy. So when you leave the job, you can convert the policy to a whole life. Again, without any proof of insurability. That's a big one. When you convert the policy, you do not have to provide proof of insurability. You have up to 31 days after leaving the job to convert. So write that down. You have up to 31 days to convert your policy to a new one. Now, just because you can convert to a new policy with no medical questions, because you're converting to a new policy, your premium is going to be based off of your new age. See, the face amount or death benefit will be equal to the term policy, but the premium is going to be higher because of your new age and because the employer is not paying a portion of the coverage themselves. And you're converting to a whole life policy, not a annually renewable term. Sebastian, any questions on that? Nope, pretty straightforward, right? All right. When converting from a group life to an individual life insurance policy, okay, we already talked about that. I know about group insurance. I want you to write the word non-contributory, requires 100% of eligible employees be included in the plan. That simply means, Samantha, that if your employer is paying for the policies, they must require 100% of eligible employees be included in the plan. Hey, Jesse. Oh, she can hear me, Sebastian. Yeah, non-contributory plans, Jarrell, require 100% of employees be eligible to participate in the plan. Require. And then the other part you want to write is non-contributory, or no, I'm sorry, contributory, require that 75%. That's all you need to know about that. Just correlate those two. Non-contributory is 100% of employees. Contributory, 75%. Okay, am I good to move on? And just give me a thumbs up. We're good to go. Okay, cool, cool, cool. Jade, you're good? Good. I see you're good. Yeah, yeah. Samantha, how are you? We're good over here? Okay. All right, look, we're going to move on to retirement accounts. Okay, this one, go to a whole new page. This one's going to be a little bit lengthy, but we're going to make it through. So we're going to talk about the difference between qualified plans versus non-qualified. I'm going to give you a very simple table here. This is going to be a little bit of writing, but I want you to write this down as a T-bar exactly like this. This right here is going to give us the absolute differences between qualified versus non-qualified. I'm going to go line by line. Contributory, or sorry, qualified accounts, they're currently tax deductible, which means certain accounts you can take off your income. So let's just say you make 100,000 a year and you contribute $20,000 to your 401k or to your IRA, to your SEP IRA. A portion of that is tax deductible. You can deduct that from your income. Non-qualified accounts are not currently tax deductible. So no matter how much money you put into that, you can't take that off your taxes. Jarrell, one thing that's important about qualified plans is that they are approved by the IRS. When you get qualified accounts, you get certain tax benefits that protect you from taxes. Non-qualified accounts does not need IRS approval. As you'll see, the qualified accounts are a little bit more regulated. They're a little bit more structured to benefit everyone. The non-qualified are more of a, hey, this can be for whoever we decide it's for. But you lose certain benefits when you don't include everybody. So the third line is the qualified accounts cannot discriminate who can participate. Non-qualified, they can discriminate. They can decide, they can tell you who can and cannot have this plan. And I'm gonna go a little bit more into detail here shortly about that. So earnings grow tax deferred. Has anyone on this call ever had a 401k at their jobs? Maybe you guys are just right out of high school. Some of you guys are right in college. Some of you guys don't even have hair on your face, Sebastian. But um, so earnings grow tax deferred. What does this mean? When you have a 401k at your job, the money that you have in your plan, you don't even see it on your check. It goes directly from your employer's account directly to it that is being invested. So all the money that is grown over the years, you don't pay taxes on it. You pay taxes on it at retirement when you start withdrawing. So all the accounts are tax deferred, which means you don't pay taxes now, you pay taxes later once you start pulling money out of the account. Is that fair? Okay. You guys got everything written down in here? Okay. So all withdrawals are taxed. One thing, Jarrell, we're not going to avoid is taxes. We're not going to avoid that. Over here, non-qualified accounts, it says over excess over cost basis is tax. We'll go into detail a little bit more about that. Okay. So under this, I want you to start a new line. We have a few retirement accounts we're going to go through, but I'm going to make them very simple for you, okay? This right here will be the longest one we have to write out very specific things for. You're going to write down the word traditional IRA. The word traditional IRA. So traditional IRA, the only way you can contribute to that is earned income. So Jade, when you're writing this down, you write earned income is the only way to contribute to a an IRA. An IRA stands for individual retirement account. If you all are working, you all need to have a Roth IRA. I'm going to encourage you all, Sebastian. I don't care if you're making 1,000 a month. You should all be putting $25 a month aside into your Roth IRA. Okay. You can make contributions regardless of age. A 15-year-old can have a Roth IRA. Okay. I want you to write under IRA, I want you to write contribution limits. Under IRA, I want you to write contribution limits. And you're going to put, give me a second. This thing always changes every year. 2025 IRA. So you're going to put IRA contribution limits is 7,000 a year. 7,000 a year is contribution limits for an IRA. And then after that, underneath that, I want you to write contribution limits for 50 and older is 8,000. So 50 and older, you could put 8,000 a year. And I want you to write in parentheses, it's called catch-up contributions. In parentheses, put catch-up contributions. They allow you to put a little bit more in because you're getting closer to retirement and maybe you're not where you need to be. Okay. Jade, Phil, any questions on that so far? Okay. The thing you want to know underneath that, I want you to write penalty. Under contribution limits, I want you to write penalties. 10%. If you pull out before 59 and a half, so 10% tax penalty if you pull out before 59 and a half. And if you guys know me, I got a bunch of kids. There's no pulling out before 59 and a half on my side. There we go, Sebastian. Smile, buddy. Come on. Trying to get you guys to wake up. Let's have some fun today. All right. So 59 and a half contribution, 10% tax withdrawal. All right. Underneath that, I want you to write required minimum distribution. And I want you to write the word 73 years old. We're almost done with IRAs. I promise you, this is it gets easier from here. So, Jarrell, a required minimum distribution at 73 means you must start taking money from the account before 73 years old because they're going to start penalizing you for not taking money out of the account. Okay. You guys got that? Now we're going to move on to the next type of IRA, Roth IRA. These are very similar, but I'm going to give you the differences, okay? Okay, forgive me. Over here, traditional IRA. I want you to write the taxes or you pay taxes deferred. Taxes are paid tax deferred, which you will pay taxes upon withdrawal of when you withdraw money. Not right now. Okay. So the next one, Jarrell, is going to be called a Roth IRA. They are all the same. Sebastian, make sure we pay attention right here. This is the difference. A Roth IRA still has earned income. Same contribution limits are the same. The 59.5% tax penalty is the same. There is no required minimum distribution. So I don't know how you want to write that in your notes. You can just say same as IRA, earned income, same as IRA on contribution limits, same on penalties. There's no required minimum distribution. And the last part you want to write is Roth IRAs grow tax free. Right there. So write that out. Roth IRAs grow tax free as long as the account is open at least 5 years. Okay. Any questions on these? Okay. Okay. Let's move on to the next one. Bum. I already covered this. Okay. All right. So right here, it might be another point you want to add, Samantha, is that you can pull out of your IRA for these examples. If the participant becomes totally disabled, Joel, you can actually use a portion of the money for a down payment of a house, not to exceed 10,000, and usually for first-time home buyers. You can use a portion of this money for secondary education, post-secondary education expenses. And excuse me, withdrawals are for catastrophic medical expenses upon death. So these right here are the reasons you can pull out of an IRA before 59 and a half without any penalty. Otherwise, if you pull out before 59 and a half, you will be hit with that 10% penalty. Last thing we're going to talk about IRAs. Roth IRAs. Contributions are not tax deductible. So when you put into a Roth IRA, Jarrell, you can't knock that money off of your taxes. And if you put in more than the 7,000 a year, you're subject to a 6% tax penalty as long as that extra money is sitting in there. So that is a consistent tax penalty. Until you take that money out, you're going to get taxed on it. Right. Any questions on the Roth? Okay. All right, let's move on to the next piece. Um, Give me a sec. I'm going to come over here to this recap. Did you guys print this page out yet? I want to see if I can help you maybe clarify these notes. If you guys haven't printed out yet, right? Okay. I would encourage you to go back and do this, but we're gonna stay right here to simplify this. So create a new piece where it's employer sponsored plans. This right here is literally going to give you everything you need to know. And we'll add a couple extra notes to it. So the first one, HR10, also known as a KEO plan, is for self-employed. Next to that, I want you to write the word 10% business ownership. Okay. So the next one is called SEP, a small employer self-employed. Next to that, I want you to write, you can put up to 25% of your income away. You can put up to 25% of your income away in a SEP. Okay, then there's a thing called the simple plan. It's for small employers, no more than 100 employees, and you set it up as an IRA or 401k. The moment you set up a simple plan, if you do it for one person, you have to do it for everybody. Okay. The next one is 401k. What you need to write here in addition to this is just put employer, well, actually, it's right there, duh. Employer sponsored plan. Just write 401k the way it is right there. Okay. The last one we're going to talk about is called a 403b. I want you to write that word right there. Nonprofit organizations. And then next to that, I want you to write teachers, nurses. And a 403b plan, it's their version of a 401k plan. But the only people who can participate in this, Sebastian, would be people, teachers, ministers, stuff like that. And when it says tax sheltered annuity, another acronym for that is called TSA. So you write that down next to it. Tax sheltered annuity, another word for that is called TSA. Let's see here. And then next to all this right here, all these accounts, the money is tax deferred. So the money is tax deferred. Okay. Well, we are going to do this. All right. The last piece of retirement accounts, let's just see if I missed anything in there. Nope, nope. We got retirement accounts knocked out. Okay, so life insurance needs. This right here is the exact needs for life insurance. So I would just write this out individually. So life insurance needs happen in this way. Survivor protection. That would be a need for life insurance. If a spouse passes away, you need enough money for survivor protection. The next one, when you write down a cash accumulation, next to that, I want you to write whole life insurance. Cash accumulation, I want you to write whole life insurance slash cash value because cash accumulation only happens in cash value policies, no term. The third piece of where someone would need life insurance is liquidity. Next to the word liquidity, the what you want to write there is cash value that can be borrowed against the policy. That's literally the definition you want to write down. Liquidity, the cash values that can be borrowed against at any time. The fourth one, this one, Samantha, is going to be called estate creation. Now, when you buy life insurance, Joelle, you create an immediate estate, which means if God forbid a loved one, if someone passes away from buying life insurance and their family has nothing, assets, nothing saved, but they get a life insurance check, they've now created an immediate estate. They've got money coming to them. So estate creation, write the word immediate estate. When someone purchases life insurance, they create an immediate estate. And the last one is estate conservation. If you make a certain amount of money, generally this is very wealthy families, if they pass away, they have to pay an inheritance tax on all the stuff that they inherit. So you can use life insurance proceeds to pay the inheritance tax. So the beneficiaries don't have to sell off the assets to pay the taxes. How sad would that be? You saved up all your assets and then you leave it to your family and they have to sell it just to pay the taxes. Doesn't sound right. Get taxed in so many areas, but hey, that's welcome to the Western world, right? Any questions on life insurance needs and suitability? Gerard, you got everything? Okay. Business needs. Okay. There are certain times in where someone would need life insurance to help with a business plan. The situation is this. We're going to go through these policies. First one is called key person insurance. You write this down. You will absolutely see this on the exam. Key person insurance is when an employer or a business has life insurance on you because you're a huge asset. So they're going to buy life insurance on you and then they're going to pay the premiums. And if you pass away, the business gets the money. I'll give you an example, Jarrell. Let's just say you and I are in business together and you are a key person. Like my business couldn't operate without you. We would have a life insurance policy on you that if God forbid something happens, we can use that money to either hire someone new, tie the business over till we find somebody, or even to replace revenue that we're missing out on because you were such a key piece. That's a pretty big deal, right? Now, Sebastian, let's talk about how does that work? The key employee, the key employee is the insured, but the employer is the policy owner. They're the beneficiary too. This money doesn't go to your family. This goes to keep the business in place. Okay. Any questions on that? Let me know when I'm good to move on, y'all. Just kind of give me a thumbs up. I gave you a lot right there. Okay. We're going to move on to the next piece. The next piece is this: buy sell agreements. Sebastian, let's say me, you, and Jarrell go open up a restaurant. A buy sell agreement would simply mean, actually, let me just read it right here. Here's an example of how a buy sell agreement would work. A cross purchase plan buy sell agreement says partner A and B are partners. So the business has a value of $1 million. Each business partner has an equal share of $500,000 each. A partner buys a life insurance policy of 500,000 on B, and partner B buys a life insurance policy of 500,000 on A. If partner A dies, partner B gets 100% of the business because he will give the heirs the $500,000 to buy him out of the business. Does that make sense? Sebastian, any questions on that? Nope. Jarrell, Jade, Samantha? No. Buy sell agreements are a big way to actually make money working with small business owners and big business owners. Um, this right here is a recap of things we've already covered. Okay, this right here. This is called modified endowment contract. We're going to keep this very simple. A modified endowment contract is a life insurance policy that is designed to help you grow cash very fast. But what happens is if the money grows too fast, means they've overfunded the account, it will be what is called fails the 7-year pay test. So I just want you to write MEC, modified endowment contract, put fails the 7-year pay test. And then the other thing I want you to write is once a policy fails the 7-year pay test, it becomes a MEC and it will always remain a MEC. That's all you need to know. You don't need to know all the intricacies of it. A modified endowment contract simply just says if the life insurance policy that is overfunded and the cash value grew too fast and it's going to lose the certain tax benefits. That's all you need to know. Okay. Last part of this we're going to cover Social Security. This is the real name for Social Security: old age survivors and disability insurance. So write that down. In order to qualify for Social Security, it's got to work in a couple of ways. It's how much have you worked? What's your status of your disability, of your retirement, of your old age? So I'll give you an example. The fully term insured has 40 quarters. This is what you want to write that down. Write everything that's in this highlighted. The fully insured refers to someone as 40 quarters of coverage or equivalent of 10 years of work. So, therefore, they're entitled to receive Social Security, retirement, premium free Medicare, Part A, survivor benefits. So, fully insured is 40 quarters. You want to write the word currently insured or partially insured. You're going to write 6 credits or 13 quarters. Partially insured, currently insured, 6 credits, or 13 quarters. So, who could actually receive Social Security? If you have a parent that dies and you're underage, or if you have a spouse that dies and they were receiving Social Security, you may be entitled to their Social Security. So, if someone dies, if someone becomes disabled, you can get benefits, or if someone reaches old age. Like Jarrell, how great would it feel to pay into a system for 40 years and when you get to 65, 70 years old, the government's going to give you a check? That sound good? Don't count on that. That won't be there for you. It won't be there for any of us. We're all too young. Social Security is actually supposed to run out in 2034. Crazy when you think about that. What they're going to have to do is they're going to have to push Social Security age because right now it says 66. They'll probably push Social Security back to 70, 75. What the frick? How much longer are you going to live? Um, this is the last piece you want to know. The blackout period. Write that down. Once a minor reaches 16, the parent is no longer eligible for retirement benefit or the parent is not eligible for Social Security benefits until retirement. That is called a blackout period. Okay. Any questions on this? You guys should have some questions unless I'm that good and you guys are that good at understanding everything, which I assume you are. All right. Am I good to move on? If I'm not, let me just give me a thumbs up when you're ready. All right. All right, guys, let's go ahead and take a quiz. And please feel free to unmute yourself. I'll take this quiz one more time. Simple plans require all the following except. Go back to what we said about simple plans. And just based off of your notes, what would you go with? All of the following except. So you're looking for the wrong answer.
D.
D. Good job. Simple plans are available for small business employees that employ no more than 100 employees, receiving at least 5,000 in compensation. Maybe even run a right, add that to your notes. The employee's receiving at least 5,000 in compensation. Add that to your notes so you have that for future reference, just in case that comes up. All right, let's go on to the next one. All right. Which of the following best describes tax advantages of qualified plans? I pretty much said this one a lot in that chapter, so you guys should be easy to figure this one out. All right, Jarrell, what you got? Sebastian, what you got?
Uh, B maybe.
You said B?
I say C.
Okay, okay, okay. We heard from Samantha in the building. Let's go. There we go. Um, all right, so
Uh,
go
I
ahead.
was going between B or C, but I was gonna eliminate A or D. I was stuck between B or C though. I don't know.
It is definitely between one of those answers for sure. Jarrell, let's go with your answer. So it says distributions prior to 59 are tax deduct or tax distributions to 59 and a half are tax deductible. No, no, definitely not. Distribution means you're taking the money. So distributions wouldn't be tax deductible. Contributions would be tax deductible. So contributions can be tax deductible, but distributions are definitely not. Distributions are taxed. But Samantha, yeah, you got it right. The earnings in a qualified account are tax deferred. So remember, when any of those employer sponsored plans, the money is invested tax deferred. You follow me on this one, Joel? Samantha, I see you about to unmute yourself. You have a question?
Yeah, it was the one that was about like 5 years, right? Is that the one? Like
Five.
after 5 years, then you can like get anything.
So that would be a Roth IRA, and the account has to be at least 5 years old.
Oh, okay.
This right here is talking about qualified accounts. The Roth IRA is the only one that has that 5 year period where you can pull it out for those special reasons. Everything else, if you pull out before 59 and a half years, there's a 10% penalty. Drew, any questions on this? No? Okay. All right. In a life settlement contract, who does the life settlement broker represent? Life settlement contract, the broker. Remember, the broker is the one out there searching for the the looking for the policies owners.
Would it be D?
The life settlement.
Oh wait, no. Would it be the insurer?
So the insurer is the person that's owning the policy now.
Okay, so what would be the owner then? Because I thought that would be the owner of the policy.
Forgive me. The insurer is the insurance company. The owner would be the owner of the policy. Then
Okay, so it is D then, because
then
it's the person who's trying to buy the settle. I mean the thing.
we'll see. Okay.
Okay.
So it was not D, but let's see what it says. Life settlement broker is a person who, for compensation, solicits, negotiates, and offer negotiation for the life settlement contract. Life settlement broker represents the policy owners, only the policy owners. So the broker is, in the example for us, would be an agent. Their job is to make sure the client gets the best deal for themselves.
Okay.
So like when you think of a broker, brokers they look out, they can shop the policies, whatever. So if you don't have that, maybe you want to write that definition down because that's nothing more than a definition right there that you could have got right. So if you just want to take a snapshot of that, not Snapchat. Um, you guys still use Snapchat?
I just use it to text my buddy, but that's it.
Is that a thing for you guys, Darrell and Samantha? Y'all still use Snapchat? Snapchat's not a, I deleted that app a while ago. All right, so let's go on to the next one. What is the official name for the Social Security program?
The old age survivor disability income insurance.
Good job, good job. See? Boom. All right, what is the main purpose of the 7-year pay test?
A.
Determines if it is a mech. Boom. Good job. 7-year pay test determines whether the insurance policy is overfunded or if it is a modified endowment contract. In other words, the cumulative premiums paid during the first 7 years of the policy must not exceed the total amount of level premiums that would be required to pay the policy up using guaranteed mortality cost and interest. Okay. An employer has sponsored a qualified retirement plan for its employees where the employer will contribute money whenever a profit is realized. What is this called?
Profit sharing plan.
Okay, so employer has a sponsored qualified plan or for its employees where employees will contribute money whenever a profit is realized. It is called profit sharing. It's pretty straightforward there, right? Good job. All of the following are true of federal tax advantages qualified plans, except. So now we're looking for the wrong answer. This is the tricky one. They're going to mess with you guys here. I see it already. So maybe when you start looking at these ones, maybe you start doing process of elimination first. So again, you're looking for the wrong answer.
Is it C?
Employer contributions are tax deductible as ordinary business expense. That's actually true in an
Repeat
essence.
why again?
What did you say?
What did you say? I said repeat it.
I said employer contributions are tax deductible as ordinary business expense. It could be because that's why the employees give you benefits to count off their taxes. Um, but let's go through these
Is
one by
B.
well, let's go through these one by one. An employer and employee contributions are not counted as income to the employee. Yeah, they're not the contributions are not considered income, so they're not gonna tax that. Funds are accumulated on a tax deferred basis. So remember, any money you invest into a 401k, 403b, TSA, Keogh plan, HR10, simple, SEP IRA, traditional IRA, the money grows tax deferred. Okay. Employer contributions are tax deductible as an ordinary business expense. That could be Sebastian. But then look at this one. At distribution, all amounts received by the employee are tax-free. So what do we know about tax deferred, qualified accounts? They are all tax deferred, not tax-free. See right here, Sebastian, you could be right here. I'm leaning towards this one because of that's what I see. Let's go with D and see if I was wrong. I was right. Okay, okay. Funds in a qualified plan accumulate on a tax deferred basis. However, at distribution, any amounts received by the employee will be treated as ordinary income for tax purposes. Do you see where they try to trick you with all this other stuff? That one little word, tax free. As long as we know that qualified accounts are tax deferred, the only account that is tax free growth is a Roth IRA. Everything else is tax deferred. Any questions on this question? Nope. Okay. All of the following characteristics of a group life insurance plan, except a minimum participation is required in order to underwrite the plan. The cost of the plan is determined by the average age of the group. There is a requirement to prove insurability on part of the participants, and the participants receive a certificate of insurance as proof of their insurance. So all of the following characteristics, all the following are characteristics of group life insurance, except.
B.
What are you saying?
B.
C? I think C is a good answer to go with. Good job. There's no underwriting. So right here, if you didn't know these, well, there we go. There's little extra things you can add to your notes right here, Sebastian, about group insurance. The average cost of group insurance is based off of an average age of the group, and there is a minimum number of people that required in order to have the plan in place. Who may contribute to a Keogh plan? HR 10.
B.
B. You got it right. Self-employed, right there. All right. An insured surrenders his $100,000 life insurance policy. The premiums paid into the policy up to $15,000. He surrenders the policy, so he's cashing it in. The value, Jarrell, is $18,000. What part of the surrender value will be taxable as income? What do you think this is, Sebastian? He's paid $15,000 into the policy. The cash value is $18,000. If he cashed in the policy, how much is going to be taxed as income?
3, right?
Say it again.
B.
B. Why would you say B?
It's just because that's the difference between it.
It's the difference of what?
The 18 grand and the 15 grand.
Yeah, that's the profit, right? So yeah, you would owe taxes on the profit. Simple enough. If you've paid in 15 and your cash value is 18,000, you're going to pay the difference of 3,000 as income tax. So good job. All right, an IRA purchased by a small employer to cover his employees is known as what? I don't think we cover this. I think we may have skipped over this portion or it didn't make sense. Off the back, we can get rid of A and D because they have nothing to do with an IRA.
I was gonna say simple plan, but I guess it's
So it could be a simple plan because that stands for SEP IRA.
Yeah.
Let's go with that one. Defined contributions. I don't remember seeing that, but that could be in there. Okay, we got it right. Do you see how the process of elimination, once you've gotten used to seeing the information over and over again, it'll just stick out? Good. All right, group life, Jarrell, is a single policy written to provide coverage to its members of a group. Which of the following statements concerning group life is correct? Look at your notes, guys.
C,
Why are you choosing C?
because that's what we wrote on our notes, for the 100% is not contributory.
Ain't it that daggum simple? Everything I told you to write down is right there on the exam. No extra stuff. Let's go. Good job. All right, partners in a business enter a buy-sell agreement. We talked about this, which states that should one die prematurely, the other would be financially able to buy the interest of the deceased partner. What type of insurance may be used to fund this agreement?
It was C.
Good job. Yep. It's absolutely any form of life insurance, guys. Don't let them confuse you. It's C. Any type of insurance can fund a buy-sell agreement. Okay. Who is the third party?
A.
Mm-mm. This is the very first thing we went over. You see,
C,
it's C right there. A third party is a person who is not the owner or not the insured. Remember, when you buy a policy, it's the policy owner, which can be the insured, or the policy owner can buy a policy on someone else, which now makes them a third party. Okay. All of the following employees may use a 403B plan for their retirement account, except
C,
you said C. You got it right. Guys, y'all passed this with a 93. Good job, y'all. Good job. What do y'all have y'all noticed that if you take the note specifically what I told you to write down, we got all the answers right? This ain't nothing but repeat, 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 repeat. But I'm proud of y'all. We've got through chapter 4. All right. So chapter 5 and 6. We're not gonna get to this today or tomorrow. I'm not available tomorrow. I'm actually gonna tell you guys to go read these ones on your own for now. Because these are literally just definitions. There's nothing in here, Jarrell, that I can teach you that's going to help you remember this anymore. Just come through here and actually write out just the highlighted parts. That chapter recap is a big deal. Let me see. I would tell you to just daggum print out this chapter recap right here. That gives you everything you need to know, all the major points. Let's go to chapter 6. And chapter 6 is nothing more than a review on the other stuff. What is the chapter recap on this one? Yeah, this is right here is a lot of recap of the first 3 chapters. I want you guys to get through this stuff this weekend. Get through chapter 5 and 6 on your own. Have you guys already passed chapter 1 through 3 on your own yet?
Almost.
Okay, and where are you at, Samantha? Like, what chapter are you?
3.
Okay, perfect. And Jarrell, where are you at?
I think I'm at 3.
You think you're at 3 or you are at 3? Did you pass the quiz for chapter 2 yet?
Yeah.
Okay, so then I want you guys to put in time, finish up the rest of your chapters this weekend, okay? Um, you're I don't care how you pass the exam. Here, give me a second. Let me get off this daggum YouTube. Can't give YouTube all the other info.